think obviously Q2 is going to be a major headwind for earnings, but I think looking through that, we still expect a decent recovery through the second half of the year, albeit that might continue to be narrow as it has been in the last few weeks. So we still think that the market is reasonably well supported by activity, and you've seen that in economic data that's been coming through, albeit that, as I say, we might see a little bit slower pace through the second half than we've necessarily seen in the last 8 weeks.
I'm very interested that you look at mid-cap US equities as well, because the cyclicality of that broader base of companies than perhaps the NASDAQ as well has meant that the index and, for instance, the Russell 2K have traded at a stunningly significant discount to some of the bigger indices out there as well. Are you saying we could see a cyclical recovery that will benefit a broader base of stocks out there?
Well, I think that's certainly the case, but it's also just coming back to what we were just discussing on earnings. You don't have to make overly onerous assumptions on earnings over the course of the next 2 to 5 years for mid-cap US equities to actually achieve a very positive outcome. So when I put it relative to, let's say, for example, European stocks, then quite simply with the level of stimulus that you've had in the US, with the earnings recovery that we're likely to see, albeit muted, and as I say, just the need not to necessarily stress earnings a lot higher than they currently are. Actually, we just perceive that as a favourable risk-reward return, certainly on a relative basis versus other areas that are also seeing weakness.
Pierre, I want to ask you about REITs. I stumbled across the real estate sector the other week, and I was just wondering why it was getting a decent bounce. And I went digging, and I saw that many of the big stocks in the basket were not the typical REITs that you'd expect, related to office exposure or shopping centres. In fact, there's just been a remaking of this sector around the logistics supply chain, all those warehouses, and also cell towers. Clearly, as we see more and more connected devices, it plays into the cell towers, not to mention data centres with remote learning. So just give us a sense of what you're now seeing in terms of the appetite for that sector, and how much has already been baked into the REITs now?
Right, so your point is a very good one, which is precisely what we're buying into with our portfolios when we look to access that sector, are areas like telecom towers, data logistics centres, precisely because they may not be necessarily the most attractive and sexy sectors to be in, but the free cash flows that they generate are stable, long-term. And so from that kind of perspective of lacking volatility in terms of earnings or cash flow, we find that attractive. We think it's also a sector which doesn't garner attention in terms of the weight that it represents in the index, but it is meaningful. And so we're buying into real estate precisely on that premise, which is actually, it does constitute a significant amount of the real estate exposure in the US with an attractive cash flow and earnings profile, albeit perhaps not the headline-grabbing ones that you might see from precisely shopping malls, etc., which, as we know from the broader S&P 500, are continuing to struggle. And certainly, risk appetite is going to remain contained for that particular subsector as long as there's an ongoing discussion about whether we see a pause in the reopening. So we're less looking to access that more cyclical element and really access instead the quality, high free cash flow plays that there are within the broader real estate sector.
Pierre, can I ask you about rates then? Because as we talk about rates being interest rate sensitive, there are other components of the market too, very much interest rate sensitive for a different reason. And there is a feeling that if you get more stimulus, that tech could get another boost as well. What do you make of what we've got on that US 10-year Treasury yield and also on the short-term rates? Because there is a feeling that, well, maybe we'll get more QE or the Fed could in fact go negative on rates. What's your feeling on monetary policy at this stage and the implications?
Sure. Well, look, I think it's likely to remain accommodative for the foreseeable future. I think the Federal Reserve want to maintain real yields as low as possible to accommodate a recovery. Certainly, we've seen that feed into the kind of primary issuance that we've seen in the debt markets at record levels over the course of the last few months. So I don't think that accommodative stance is likely to be changing anytime soon. That said, I think from a portfolio point of view, what it's led us to do is pivot away from nominal government bonds into inflation-linked government bonds. on the view that if you do see a recovery over the course of really the next 2 to 3 years, then you should also see a pickup in inflation, which comes from that monetary stimulus. And that's a view that we tilted into over the course of March and April and brought further into the view over the course of that time. And certainly we've seen 2-year to 5-year inflation expectations in the US improve. So we continue to hold that position.
Yeah, I've got about 40 seconds left. You anticipate a W-shaped economic recovery, but will there be a W-shaped equity market move as well? Because, of course, a lot of geniuses out there, people who earn far more money than me and know far more about markets, they've missed it, haven't they?
Yeah, a lot of people have missed this recovery. It's been a thin participation. Could it be the same for equities? Yes. I mean, look, I think any dip in equity markets will be well bought, given the wall of liquidity that's out there. But I also think that it's going to continue to be a multi-speed recovery in terms of sectors beneath that headline number.